Hello everyone, welcome to Fundamental Analysis. My name is Varun Kapoor and I appreciate you watching this channel. If you do like the content that you see today, then please do like and subscribe this video and I will make sure that I make more content in the future. Up today, I wanted to discuss one of the names that I have been invested in. It's called British American Tobacco. A little bit of a controversial name. It's a sin stock and it's a very interesting story. So let's do some quantitative and qualitative analysis to see what kind of return a long-term investor could aim to achieve in a stock like this. So let's jump in. So what does British American Tobacco do? As the name suggests, it's one of the largest tobacco companies in the world. It's got operations all across the globe. It's got some of the top tobacco brands. It's got 60 billion in market cap. It's got about 40 billion sterling in net debt, and it's about 12 billion sterling in EBITDA. So it's a very, very large player in the market. So what do I like about this name? And it's been going on for more than 100 years. So it has expertise in operating across the globe. It sells a highly addictive product. It essentially means that it has the ability to pass on price increases to its customers, which is a very strong power to have. The brand loyalty in a tobacco product is very, very strong. So we will see regularly that people who smoke one type of particular cigarette, they are reluctant to shift over because of the effects that it does or does not provide to them. So the brand loyalty, once you get hooked onto a particular type of tobacco product, is very, very strong. There are 3 or 4 large players in the market. Philip Morris, for those of you who follow the tobacco industry, Philip Morris, Altria, and British Tobacco are 3 of the largest players out there. And the ability for new players to come into this market is now very, very restricted. The company is highly, highly profitable. It generates about more than 40% EBITDA margin consistently, and we will dig into the numbers to see how they look like, but it's consistently generating more than 40% EBITDA margin, which is extremely strong. And not only EBITDA and EBITDA margin, its ability to convert that EBITDA into actual cash flow is extremely strong as well. So there is quite a bit to like from an operational perspective. So if you think about all these positive things that a normal investor is looking for, you would normally expect that the share price for this name should have done quite well. So let's see how the share price has performed. So this is a very interesting chart because I just mentioned a lot of things that you can like about this name, and there is a lot of strong equity characteristics that this name demonstrates. But if you look at the share price analysis over the last 5 years, it's been a very difficult story. It's the share price in 2017, it went as high as 55 pounds a share, and it's seen a consistent decline till 2019 when it hit about 27, 28 pounds. And since then, it's been basically going sideways. So it hasn't really moved in 2 years' time. And therefore, if there are lots of good things to like about the name, but the share price is doing this kind of pattern, you need to worry and you need to ask the questions, what's actually happening with the credit? So let's see why the share price has struggled. So here you can see there are some reasons why the share price has fallen. So we'll just rattle through these. Tobacco market as a whole is a declining market. So the volumes of tobacco consumption in the world have been consistently going down. Even for Philip Morris, Altria, and British American Tobacco, the traditional cigarette consumption on a volume basis is declining every year. As an example, British American Tobacco last year said that their volumes for traditional cigarette sticks fell by about 3%, and that provides a headwind. There are some reasons given here why I think some of those reasons can be actually mitigated. So although the demand for tobacco is going down consistently, they have very strong ability to pass on price increases to the customers because of the loyalty and addictive nature of the business. So although the volume has been going down, they have consistently been able to increase their prices, and therefore the overall revenue has actually been flat to slightly increasing on a constant currency basis, as we will see in the financial analysis. Increasing ESG concerns, which basically means that a lot of investors who are just barred from investing in the name like this, which basically means that the share price has fallen because they have been forced to redeem their positions. I don't think that this is a trend that's actually going to change, and therefore the valuation discount that we are seeing in this name compared to some of the other industries, I think, is likely to continue. Having said that, Philip Morris and Altria, they trade at a valuation premium, so there is a discussion to be had whether there is going to be a re-rating of the stock such that the valuation that Philip Morris and Altria get, this name will be able to achieve on an enterprise value to EBITDA basis. Industry is essentially in a transition. The demand for traditional cigarette sticks, traditional tobacco products is declining. As I mentioned, the demand for vaping products, e-cigarettes, and tobacco heating products is increasing, and that essentially means that the industry is essentially in a flux where one legacy part of the industry is going down, the next generation products, as they're called, which is e-cigarettes and tobacco heating products, is increasing, and that is a little bit of a difficult transition for an equity investors to lend into, because the industry is essentially changing, and we need to make sure that we are backing winners in a dynamic and changing industry. The risk of lawsuits. This company has been operating in this industry for more than 100 years, and that essentially means that it will be able to navigate this complex and challenging environment that tobacco companies face these days. The tobacco heating product is an interesting dynamic. So if you look at British American Tobacco, 10% of their revenue comes from next generation products, 90% of it is traditional tobacco. Within the next generation products, we see that the vaping segment, they have a product called Vuse, which has been doing quite well, and they've been growing their revenues quite strongly on that. But on tobacco heating product side of the market, Philip Morris's product, which is called IQOS, is a first mover, and it is significantly far advanced than British American Tobacco's product, which is called Glow is, and that is a issue for British American Tobacco, because once people get hooked onto IQOS, there is a risk that they're not going to move on to the Glow product. So this is the historical financial analysis. Like last time, I've done 5.5 years of historical financial analysis. I will just rattle through it in the interest of time. So they made a big acquisition here, so I think we need to discount these numbers here. But essentially, if you see since 2018, 19, 20, and the last 6 months ending 2021, the company is essentially making 25 billion sterling of revenue every year. That is a mix of its traditional volume declining, but it being able to pass on price increases to the customers, which means that the revenue is essentially flat. EBITDA of this business, again, I'll focus on these 4 sections. You will see it used to be 11 billion sterling, and it stayed at it's increased from 11 billion to 12 billion. So although the volume is declining, the increasing prices means that the EBITDA for this business has been steady to slightly increasing. Now, EBITDA, as I always say, is just a profitability metric. What we care as value investors is how much cash the business is generating. So this is essentially an analysis of free cash flow available to equity holders. And you will see here that the company is essentially been generating about 4.5 to 6 billion in free cash flow for the last few years. I will point out that the company made a very large acquisition, so company has been paying down its debt pretty materially. So if I look at the free cash flow available to equity holders, but before debt payment, that amount is in excess of 7 billion, and I will explain why that amount of 7 billion is relevant for our analysis. And some valuation metrics here. You can see here in 2017, the business was valued at 17.5 times enterprise value to EBITDA. And then it's gone from 17 and a half times to almost 8 and a half times. So that basically mirrors the share price correction that we have seen. The Food and Drug Administration in the US has severe concerns on some of these tobacco heating products and vaping products, and therefore there's higher scrutiny that these products will not be able to sell as fast, and that has led to a correction in the stock price. So in my view, a company of this nature, it operates in an industry which is a challenging place to operate. I would say that this pricing was on the higher end, and if this name was trading today at 17 and a half times enterprise value to EBITDA, I would not be investing in a name like this. Now the valuation has gone from 17 and a half times to 8 and a half times. So the obvious question to ask is this a value trap? What is a value trap? A value trap is where you think a share price is low and you buy it. But I don't think this is a value trap, because a value trap name essentially means that your profitability keeps declining year on year, such that you think the share price that you're buying is low, but it keeps on declining. In this case, we haven't seen any proof of profitability declining. If you remember the EBITDA numbers that we talked about, the EBITDA numbers have been relatively robust, and therefore I think it has reached the stage where the share price is now reflecting all the risks rightly that we see in the stock market. So how do we forecast a name like this? So I use two methodologies. One of them is called enterprise value to EBITDA methodology, and the other one is called free cash flow yield analysis. So remember, this company has been generating, as I said, about 4.5 to 6 billion in free cash flow after paying debt holders some repayments, which is a very strong cash flow yield. The cash flow yield over the last 5 years is an average of 6% cash flow yield after debt repayment. Here, revenue growth very quickly. I think the easiest way to model this name is to assume that the business does not grow. It's been stable at 25 billion, and my forward-looking numbers, I've assumed that it stays at 25 to 26 billion in revenue. Here, the numbers are at 2.5% and 2% because the management has confirmed that they believe they will be able to hit these numbers. EBITDA margin, last 5-year average is 44%. I've assumed it's 43% going forward just to be conservative. And this is free cash flow available for equity holders as a percentage of EBITDA, which has been for the last 5 years, as we said, is 48.2%. And I've increased this going forward from 48% all the way to 58%. The reason is that the company has been paying down a lot of debt. Now it's reaching a stage where their net debt to EBITDA is going to be 3 times. That's their target, and they're going to stop repaying debt, and that cash will then be available to equity holders going forward. And that's why we will see, as time passes by, the company is generating more cash for its equity holders. If you sum up all the free cash flow that the company is generating in the next 5 years, I get to a number of about 30 to 32 billion. The company has confirmed that they think it's going to be 40 billion. So the company is actually assuming 20% higher free cash flow calculation than we are doing. But I think 30 to 32 billion is a reasonable number because we want to be more conservative than what the company is saying. So in terms of valuation, here we assume two methodologies, as we said. Average 5.5 year free cash flow available for equity holders yield has been 6.8%. So if you assume that in year 2025, our free cash flow is the number that we saw there, we get an exit market cap of 94 billion sterling. The other methodology is enterprise value to EBITDA. The last 5-year average is 12 times. If you remember, I said the company was overvalued in the past because some of the risks that we see in this industry had not been taken into account. The current enterprise value to EBITDA is 8.4 times, and I've assumed that the company stays at 8.4 times in this. So we get two methodologies, one of which gives me a market cap of 94 billion. The second one gives me a market cap of 62 billion, and I have basically split the difference to assume that in 5 years' time, company's market capitalization is 78 billion sterling. So what does it mean in terms of IRR analysis? So this is the existing market cap. The investor can buy at 59 billion. These are the cash flow, the free cash flow that we talked about. You will notice that they're increasing because the company is going to generate more and more cash as time passes by. And this is the exit valuation, which is 78 billion, which we talked about. And that gives us an IRR of 14.2%. So I think this is again a pretty solid name. I would mention that this is not a name where you can expect that your money is going to double or triple, or it's not effectively a multi-bagger as some people call it. That's because I think the demand dynamics essentially mean that the revenue for this business is going to stay flat or even slightly decline going forward. But the company generates so much cash flow, and that cash flow is relatively robust, such that you should be able to achieve 14.2% IRR over the next 5 years. The risk to achieving this 14.2% IRR is essentially that the company is not able to develop or deliver the next generation products that they have promised. Risk. If the company is not able to do it, I don't think you will be able to achieve 78 billion market cap at that point of time. And if the market cap stays at 60 billion, which is roughly the number that we have today, this 14% IRR will effectively change to 8%. So I don't think that this is a name where you're going to lose all your money, and the free cash flow generation is so strong that you should make a reasonable IRR in this name. But I think for investors who are looking for 20, 25%, 30% IRR in their investments, I don't think this is the name that they should look at. So I think this is a good name. You need to focus on the next generation products, on how it's developing, and I think this is a name where if the company is able to deliver in the next 6 to 12 months the next generation products, then I will be adding that name at that particular point of time. For now, I'm watching it closely. That's it for this time. If you like the video, then please do subscribe and like the video, and ask me questions if you have. I will make sure that I will answer those questions in time. And until next time, thank you for watching. Bye now.